Understanding leads and lags in international business. In the complex world of international business, the term leads and lags refers to strategic financial maneuvers employed by corporations and governments to manage foreign currency payments. This article delves deeper into the concept of leads and lags, illustrating how businesses can leverage changes in currency exchange rates to their advantage and the associated risks involved. What are leads and lags? Leads and lags are tactics used to time foreign currency transactions purposefully. By either advancing, leading, or delaying, lagging, payments, entities seek to exploit favorable fluctuations in exchange rates. For instance, if an organization anticipates that the currency it has to pay will appreciate, it may opt to make the payment sooner to benefit from the current rates. Key takeaways. Leads, paying earlier than scheduled in anticipation of a favorable currency exchange rate. Lags, delaying payment with the hope that the future exchange rate will result in a more favorable cost. Both practices allow businesses to manage their financial exposure in global markets effectively. The mechanics of leads and lags. When conducting business internationally, corporations possess a certain degree of flexibility regarding payment timelines. For example, if a business plans to acquire a foreign entity, it may choose to either expedite the purchase or postpone it based on currency predictions. Strengthening currency. If the currency due for payment is strengthening, paying sooner may be more advantageous as it would prevent higher costs later. Weakening currency. Conversely, if the currency is predicted to weaken, delaying the payment could reduce expenses. Example scenario. If a U.S. company is acquiring a Canadian subsidiary and expects the Canadian dollar to depreciate against the U.S. dollar, it would strategically delay its payment. This way, it could acquire the Canadian asset at a lower price in U.S. dollar terms, capitalizing on the anticipated decrease in the Canadian currency's value. Risks involved with leading and lagging. While employing leads and lags can yield benefits, it is not without its risks. The unpredictability of currency markets implies that rates may move contrary to expectations. Various factors influence currency prices, including geopolitical events, economic indicators, interest rates, and overall trader sentiment. Currency market dynamics. The foreign exchange, forex, market is inherently volatile. Transactions typically settle at the spot rate, which can shift within days based on trading activity. Currency forward contracts. To mitigate risks, businesses often use forward contracts that lock in exchange rates for future transactions, providing certainty against fluctuating rates. In essence, leading and lagging are timing strategies that come with the caveat that currency movements can defy forecasts. Predictable events impacting currency exchange. Certain political and economic events can offer insight into potential currency fluctuations. Predictable schedules surrounding events like elections, interest rate announcements, or regulatory changes can give companies an edge in anticipating currency changes. Election outcomes. Political shifts can dramatically impact the strength of a country's currency, as seen with the United Kingdom's Brexit referendum in 2016. Subsequent drop in the British pound highlighted how rapid political changes can affect currency values. Monetary policy changes. When central banks adjust interest rates, it can lead to immediate repercussions in the currency markets. A rate hike generally strengthens a currency, which could render a lagged payment decision unfavorable. Example, the Canadian dollar. In the evolving exchange rates, a U.S. firm acquiring a Canadian asset must observe fluctuations in the Canadian dollar's value against the U.S. dollar. Between 2021 and 2022, the Canadian dollar fluctuated between $1.20 and $1.30 to the U.S. dollar, affecting the timing of payments based on fluctuating forecasts by economic analysts. A mixed strategy. To balance the uncertainty inherent in foreign exchange transactions, businesses may employ a mixed strategy, making a partial payment while delaying the remainder. This approach diversifies risk and allows companies to benefit from favorable currency movements while minimizing potential losses from adverse changes. Conclusion. Leads and lags are crucial strategies in the realm of international finance, allowing organizations to navigate the complexities of foreign currency transactions strategically. By understanding the implications of currency fluctuations and the related risks, companies can make informed decisions that bolster their financial resilience in the face of an ever-changing global landscape. As with all financial strategies, careful analysis and continual monitoring of international economic indicators are essential to effectively utilizing leads and lags in today's dynamic business environment.